Michael Wall, one stock you like over at Retire Well is Netflix. Now, they had a great second quarter earnings report last week. They beat earnings estimates, had a lot of subscribers, I think 66 million. But what takes it up from here? Because the expectations have been ratcheted up so high.
Yeah, that's a good question, Greg. I'll tell you, Netflix is really a play that I think they're first to market in a lot of ways. They are high for sure right now, but I look at them more as a longer-term 3 to 5 year play. I think there's a lot of growth in other markets, other countries that they still have yet untapped. They're doing a lot of things in the Spanish market that's really kind of first to market there as well. So a lot of the things that they're doing, that pay to play, $7.95, $11.95 a month, nobody really has done that as far as a cable alternative. And they've really done a lot of things. One other thing they've done is they've really done a good job of producing their own product. So because of that, they're starting to get a following. And I think longer term, 3 to 5 years out, they're a good play.
And you're also bullish on Facebook. They come out with earnings next week. Now, they've been hitting on all strides. But once again, the bar has been raised higher after great earnings by Google and Netflix. And they're also getting a little bit pricey. I think they're at over 34 times next year's earnings.
Yeah.
Is that going to start to nip at the heels of the investors?
I think to some degree it could in the shorter term, but I think longer term they're still a good play to buy. One of the things that I like, Greg, about Facebook is they are not only a company that just does technology online, they buy other companies as well. They got Oculus now, which is coming out with the virtual reality in January. They got 1.5 billion users in the world monthly. So that's a lot of change, a lot of data. They're really the keys to the kingdom in a lot of ways. One other thing that I like is not only are they doing good about selling their advertising online, but what they also do is they're allowing people now to do their own shops. So they can kind of set up their shop online through Facebook. So I think there's a lot of things they're doing to look to not only diversify their own brand, but within other brands. And I think longer term, they're definitely a play as well, especially with that much data.
And you're also positive on Kinder Morgan. We've been talking a lot about these fun internet stocks. So why do we want to be involved in boring old pipelines?
Yeah, well, pipeline can be boring from time to time, but it's kind of a steady eddy, Greg. I look at it as a tool taker. Whether you're on the road, whether you're driving a Ferrari or a Chevy, you're going to pay the same toll if you're on a turnpike. So the cool thing about Kinder Morgan is they're in a place where they got about 84,000 miles of pipeline. They got 165 utilities. They got $18 billion as of April 2015 that's going into infrastructure and growth this year. So I really think they're the largest holding and transport company in America. I really believe they got a lot of play. One other thing that I like about them is they have about a 5% yield. So they're getting a little pay-to-play strategy. Now, while we're looking for growth, we get paid to do it. So that's a good thing.
All right, well, speaking of yield, finally, you like non-traded REITs. Now, the IYR, which tracks publicly traded REITs, is down around 3% so far this year. A lot of worries as rates rise, it's going to hit things like REITs and utilities. Why do you want to be in these non-traded ones? A good thought there, and obviously the being down is because it's publicly traded. On the non-traded side, really what we're doing is we're building a portfolio to take to market. So what happens after market, we really don't care. One of the things that we've seen is in the healthcare field, we're buying medical office buildings, different types of properties like that, and really packaging them together. Now, the neat thing is, as a fiduciary, I'm not a broker, our clients can buy in at discounts. So we're right off the bat, they're getting a 7% bump, then they're getting about a 7 to 8% off-market yield. We're looking for off-market plays. Grocery store shopping centers are great as well, because guess what? Even if the market goes down, people are still going to go to the grocery store. All triple net lease, 7 to 10 year lease and all that sort of thing, but we're flipping it in 2 to 3 years, so we're out. And historically, we've seen that these have been really solid producers for our clients without the volatility. And then once it IPOs or hits market or gets bought out by a hedge fund or whatever, we're out. So I really like them as a kind of non-market play. All right, well, thanks a lot, Michael.
Yeah, thanks for having me.
And thank you for watching The Street.